Will your stocks, bonds, mutual funds, and savings be decimated by inflation, or will they appreciate through deflation? Well, the future is uncertain, that's for sure. But our guest today, Richard Vague, is returning to the show to talk about the impact of the national debt on the debate between inflation and deflation, and also how it redistributes wealth. So this is a very important interview. You're going to want to hear the whole thing and stay till the end to hear that. This is episode 2062. Thank you for joining me today. We have got war and violence breaking out in so many places around the world. It is definitely a time to pray for peace, and we are doing that. But we have to look at the financial impacts of this because that is what the show is about. So, of course, anytime you have the absolute terrible situation of war, you have destruction of property. There is literally no good economic value ultimately that comes out of war. However, there is temporary value through rebuilding, defense contractors, et cetera, et cetera. And you know, you've heard me say it for many years. As long as war is profitable, there will never be peace. Can you imagine all of the people who supply the military-industrial complex just thinking, oh, my wealth is growing as we have violence throughout the world? You know, people tend to do what supports their paycheck and their wealth. At some point, this really becomes an absolute sickness, a psychopathy. When you get to a certain point, I mean, how much do you need? Like, really, it's just beyond the point of ridiculousness, the power hungry nature. But look, that's the way it is. It is not going to change with my concern about it or your concern about it. It's the way of the world, sadly, but that's the way it is. So we must consider the packaged commodities investing strategy when we have natural disasters, when we have awful wars. We've got to consider that because the commodities that are required to rebuild and the commodities that are required to destroy absolutely increase demand here. Remember, packaged commodities investing, the strategy I've been teaching for 19 years, is the idea that we really aren't real estate investors as much as we are commodities investors. And we have to look at the ingredients of a house: copper wire, petroleum products, glass, steel, lumber, concrete, energy, right? All of the energy and all of the labor needed to construct a home or an apartment complex or any kind of property, right? This becomes more and more expensive as we rebuild after wildfires, as we rebuild after earthquakes, hurricanes, and wars. So the price of all of those materials is pushed up. And you see it all the time. Every time there's some big event in the world, whether it be a 9/11 type of event, whether it be a natural disaster or a war, all of the markets shift and move, and investors change their focus. And some of them know about these events in advance. So they are trading on the future, right? Because they have inside information. So look, that's the way it is, but just understand you've got to keep the packaged commodities investing concept in mind. Now, another element we've got to look at is interest rates. In times of crisis, the central banks tend to loosen the money supply. They tend to reduce the cost of money and lower interest rates. We've been waiting a while for a Fed pivot, and a lot of people thought it would happen much sooner, including yours truly. This will probably speed up the idea of a Fed pivot. We know that the Fed has really stopped their ridiculous increases, hopefully for good, but this is more likely to put pressure on them to pivot sooner rather than later, to see lower mortgage rates, lower interest rates throughout, because in times of crisis, people get concerned. They rein in their horns. They tend to save, not spend. They tend to hunker down, right? And the Fed needs people stimulating the economy. After 9/11, the famous line, remember, from George W. Bush, right? Go shopping. It's kind of ridiculous and shows the lack of connectedness to what's going on in the world, right? But, ultimately that is their goal. It's to keep people spending into the economy because we've got to keep the economy afloat. And one of the incentives they will likely use is they will loosen the money supply, they'll reduce the cost of money. And so that will have profound effects on the real estate market. I remember when I owned my traditional real estate company, we served the Newport Beach market and the Newport Coast, California market quite a bit, right? I lived in Newport Coast, California at the time. And I remember talking to one of our clients, one of my agents, Stephanie. She had sold him this property and then later had listed it for resale. And I remember talking to him when he had just listed the property. We had a phone call for some reason or another. Can't remember why, but he called me up as the owner of the company. And he was talking about his property. And I said, wow, congratulations, you really made a killing on this property. It almost doubled in value. And he said, yeah, Jason, but I bought that property right after 9/11. When nobody wanted to buy properties, right? Everybody was very fearful. But it's the famous Warren Buffett saying, be fearful when others are greedy and be greedy when others are fearful. So just always think about that. Literally, there's an entry in the Investopedia website for that quote. So very important to think like a contrarian sometimes. All right, so let's get to our guest today. Let's talk to Richard Vague. Oh, before we do that, I want to mention, and I didn't have time to mention this last week, I was busy with birthday celebrations, but we had such a fantastic Empowered Investor Pro Zoom meeting last week. Almost 2 hours I was on with our pro members, and we were discussing so many great things. So thank you to all of our pro members who attended. If you are not a pro member, this is literally the cheapest and the best investment you can make. It is so low cost. Be a member of our pro group. Join us for our monthly Zoom meetings. Sometimes we even have them more often. We throw in an extra Zoom meeting depending on topics and things that arise. But go to empoweredinvestor.com and join our Empowered Investor Pro group. Just literally the best investment you're ever going to make. I mean, of course, income property is the best investment you're going to make, but it's a lot more expensive than being a member of our pro group, which is about the cost of a cheap gym membership. Okay, so join Empowered Investor Pro, empoweredinvestor.com. Now, the Richard Vague interview, really important. This is all about the idea of how much does debt matter. We disagree a little bit on this topic, and you'll see that during the interview, but I also would agree with him. And I don't know if I agree to quite his extent, but I would agree with him that the national debt is not nearly as much of a concern as some think it is. You've sort of got the Jim Rogers school, right? And Jim Rogers, the gentleman that he is, he's been on the show several times over the years. He is like so many others. I mean, I'm just using him as one of many examples. Very, very concerned about the national debt and the type of inflation that will cause and so forth. And I agree, conceptually, that is a concern. But the question is, compared to what and how much? How much debt can a country like the US endure before it becomes a significant problem? And I would argue that it's just sort of the slow boil. It's that frog example. You put the frog in the nice warm bath water and you turn it up slowly to a boil and the frog boils, right? Animal rights people, that's a terrible example, right? But anyway, right, it illustrates a point. The frog is feeling comfortable and it just gets worse and worse over time. And that's kind of the way it is with the national debt. So inflation is likely to be pervasive for many, many years. I think that they will have to generally go in favor of letting inflation happen because they can't afford the consequences of the high interest rates for too much longer. They will generally sell out the middle class and the poor. And those are the people who get hurt the most by inflation. And they will favor the wealthy and the upper middle class who generally benefit from inflation. So you've heard me talk about that a lot over the years, but without further ado, let's just get to the interview with Richard Vague and let's talk about the paradox of debt. So here we go. It is my pleasure to welcome Richard Vague. He is the author of several books, including The Paradox of Debt, A New Path to Prosperity Without Crisis. Richard, welcome. How are you?
Great, and thank you so much for having me.
It's good to have you. Are you by chance located in New York? It looks like you might be by your your view.
I'm close. I'm in Philadelphia.
Oh, fantastic. Okay, good. Well, that's kind of where it all started. So, you have a really refreshing take on debt from a national level, right? And sovereign debt as far as it, applies to other countries as well. And it's refreshing. And that's why I wanted to bring you on the show. I was reading about your work and your book somewhere, I do not remember where, but really want to dive into this. So maybe tell us about your general thesis, if you would, Richard, in terms of national debt. Everybody is talking about how we're all, headed for doom. We've got $33 trillion in debt now, not to mention the unfunded mandates and obligations into the future. Those are pretty big numbers. Of course, they're not the biggest. Japan would be the worst in the world as we look at it. But should this be a big concern or not?
Well, we have to keep in mind that when the government spends money, it doesn't disappear. It goes largely into household checking accounts. So in the pandemic, which we measure from 2020 through 2022, government debt increased by $8 trillion, which was the $1,200 checks and the $1,400 checks, et cetera. During that same period, household wealth increased by $30 trillion. So the $8 trillion the government spent went into household checking accounts, and the flood of money from government largesse pushed stock and real estate values up by another 20 trillion. So you get a tremendous benefit. So as a general matter, government spending and government debt actually increases household wealth. Now, the caveat, of course, is most of that goes to the wealthiest. The average guy probably doesn't even feel much of that,
Right.
but in aggregate, wealth increases.
Yeah, and I agree. And, a lot of people have talked about the Cantillon effect, I guess a 250-year-old idea that the people closest to the money printer, if you will, benefit the most. And it is unevenly distributed. So that is not a good thing, of course, because it widens the wealth gap. And we've definitely seen that from the pandemic era. But just more generally, Richard, you can't spend yourself into prosperity, right? There has to be a limit to this.
Well, if there is a limit, the United States is not near that limit in its government debt. And you correctly pointed this out early on when you said the United States government debt, which is about 120% of GDP right now,
Yep.
is not anywhere near to being the highest. That's Japan at 240% of GDP.
Yep.
So if there is that cliff to fall off, we're nowhere near it.
I agree with that. And of course, we have the reserve currency. And regardless of what all of the fearmongers say, I think we're going to keep that reserve currency status for quite a while to come. So that puts us in a very different situation than Japan. Say, for example, the US had 300% debt to GDP ratio. It was worse than Japan. Where would we be then?
Well, I want to comment on this a little bit further. In 1980, total debt in the economy, that's all government debt and all private sector debt, household and business, totaled 125% of GDP. Today, that's 260% of GDP. So in ratio to the economy, it's more than double. So what happened to household wealth in that period? Well, it went from 350% of GDP to 600% of GDP. Households have gotten enormously wealthier because of the increase in debt. So if we went from our current 120% to 140% and so forth, a lot of what would happen would be that household wealth would continue to increase. Now, I want to amplify something that you also said, which is it's really the wealthy that benefit from this. Most household wealth, 70 to 80% of all household wealth, is in the form of stocks and real estate. And what the increase in debt really does is push up the value of stocks and real estate. So as debt is increased, wealth is increased, but the gap between the middle class and the wealthiest has widened considerably, because 60% of the folks in the US, the bottom 60%, only hold 14% of the stocks and real estate in the country.
Yeah, that's terrible. I mean, they're just not getting the benefit of it. And well, we need to talk about inflation. Do you want to jump there for a moment? Because I was going to say those people are hurt the most by inflation, whereas the wealthy that own the stocks, the real estate, and the mortgage debt against the real estate benefit from inflation. And Richard, you don't know this, but I have a strategy I developed years ago called inflation induced debt destruction, which is basically the fantastic benefit of having that long-term fixed rate debt where you pay it back in cheaper dollars over time as inflation happens. Now, for the record, philosophically, I hate inflation. But as a selfish investor, I'm going to try and benefit from it. So that's just an interesting thing to point out. But the folks that have only 14% share, that's bottom 60% that you talked about, that's more than half of the population, right? They're mostly not benefiting from these things. So it is very unfair and very unevenly distributed. So do you want to jump into that discussion and get into the inflation component?
Well, you're exactly right. It's the middle class that gets hurt most by inflation. Your strategy for dealing with inflation is exactly right. If you borrow and your rate is fixed at a level below inflation, you're a net beneficiary. Now, a lot of people borrow and don't have fixed interest rates. So, as inflation increases, their interest rate goes higher. So they get none of the benefit you suggest. But yeah, inflation is.
So that would be like credit card debt, for example, would be a great example of that.
Variable rate mortgages, credit card debt, the like.
Yeah, even though interestingly, the variable rate mortgage, you could still win because that mortgage rate will, even though it's adjustable, probably be lower than real inflation. And you're still leveraging. So you get the multiplier effect of the leverage, maybe, 5-to-1 leverage ratio, but that's complicated. We don't need to go into it, but definitely credit card debt, especially because that is so outrageously overpriced compared to either, stated inflation officially by the CPI or real inflation, whichever one you want to argue. The credit card debt is just a complete scam, and it's so unfortunate. But yeah.
Yeah, if there's another way to borrow, you should.
Definitely.
If you can avoid borrowing altogether other than mortgage debt, that's not a bad thing either.
Yeah, not a bad thing at all. I could completely agree with you. But my point in asking you to address this is, does the debt cause inflation? Most people would say it does, of course. And if so, how much? That relationship between national debt and the rate of inflation.
If you ask 100 people whether increased government debt causes inflation, I think either 99 or 100 of them would say, yes, it does.
Yes, right.
But there's little or no evidence to support that idea. It's one of the amazing things out there. We have a very large database of countries. By our count, 47 of the 50 largest countries in the world, we have fairly complete government, private sector debt information, money supply growth, inflation. We have all the data going back, at least to the 1970s, if not the 1950s. So we can go through and you could do this at home. You can go through and you look at every single instance of high government sector debt and see how many times it has been followed by inflation. By our count, there were 30 such instances, and it was followed by high inflation 7 times. And conversely, there have been, 30 something instances of high inflation that have been preceded by high government debt less than 10 times. We see essentially no correlation between the two. And we think that's, sorry.
When you calculate that correlation though, and you say followed by, how much lag time are you allowing for that?
Well, we've run it a dozen different ways because you can define high inflation and high government debt and the lag time an infinite number of ways. So we've iterated that again and again and again with different levels. And no matter what you do, you can't contrive, a correlation. And, you couple that with the fact that government debt in Japan grew monstrously after Japan's 1998 crisis. I mean, that's when it grew to the 200 and something percent you're talking about. Mm-hmm. And inflation was zero for the next 20 years. Government debt skyrocketed after the great financial crisis in the United States. And our inflation was, 1.5, 1.6% for the next 10 years. So it's really hard to find actual data support the idea that high government debt brings inflation.
So, Japan is a bit of a weird case. People could argue demographics, et cetera. And, the two economies around the world that always sort of befuddle economists, I think, are Japan and Argentina, right? Like those two are, they're sort of like outliers in some ways. So let's not go down the Japan road, but let's talk about the US though. You said 99 or 100 people, or even probably economists, would say that debt causes inflation, right? And, that kind of makes sense when you follow that path. You can make the argument for that very well, and most do. Why do you say that's not true? Like, tell us about the argument for that. Just unpack that for us.
Well, we're empiricists. So, no matter what someone might come up with theoretically, we then go to the actual data, which we have so much more than folks like Milton Friedman did in the 1970s. We got 50, 60 years of the most important financial data that you would ever have. We just can't find it in the data. And we can't find it in the 1970s. We can't find it in the 1960s. We can't find it anywhere. Take 1970s inflation.
Right.
It corresponded almost exactly with the increase in the price of oil, late 1973 in the Yom Kippur War.
Right.
Oil was a little over $3 a barrel in 1973.
Yep.
By the time you get to 1979, it's $40 a barrel.
Yep.
So it would be as if our $80 or $90 a barrel oil today was instead $800 or $900 a barrel. And we didn't solve inflation until, and most folks don't remember this, but the price of oil was regulated domestically. You couldn't sell it for more than that $3 a barrel. And so nobody was producing oil inside the United States. So between Carter and then Ronald Reagan, they deregulated the price of oil at the wellhead. Price of oil went up to $15 to $30 a barrel almost immediately, and everybody rushed to produce oil. Drilling rigs went from 1,500 in 1977 to 4,500 in 1982.
Wow.
And guess what? The amount of oil produced in North America increased by 25%. And I was in Texas at the time, so I remember this well. The price of oil went from $36 to $10 in 1986.
Yeah.
And by the way, inflation went from 4 or 5 or 6% to 2% when the price of oil dropped. It had nothing to do with monetary policy. It left a lot of drilling companies bankrupt, by the way, when that happened.
Yeah.
They were all over Texas, but that's what was going on. That's what brought inflation down. And by the way, money supply and government debt growth were very high in 1986. Money supply growth, Volcker had not cured or solved the money supply growth, nor the government debt growth. It was one of the highest periods of government debt growth in U.S. history. Remember the military buildup under Reagan?
Sure. Yeah. Right.
That was 1986.
Yep.
As government debt growth was accelerating, inflation dropped to 2%. So I just, if somebody wants to make that argument, let them make it empirically.
I get where you're coming from on the data, which, by the way, I got to mention a couple other things before we go to that, but we'll go back to that in a second. So great argument against price controls. Nixon's price controls were a disaster, obviously. But then you probably saw the oil market sort of overexpand when the deregulation happened.
Without question.
And then it got into balance after the crash, right? So that's sort of a normal supply-demand kind of a situation. But what I want to know is not the data, which you have, and that's fantastic, but the reason. Like, what do you think? You must have a theory about this. Like, why is it true?
Yeah, I don't think, monetary systems have come and gone. For the first 7 or 8 years of this country's history, a period in which we grew to surpass the UK as the largest economy in the West, we didn't even have a currency, and we had no central bank. So the importance of the currency and the amount of currency and the presence or absence of a central bank is, I think, overdone, in my view. We have had inflation. We've had 9 instances of inflation in the US, and they have more or less all related to a collapse or a diminution in supply of goods. Most of our inflation has been associated with war. World War I's a great example. 2/3 of all the agricultural land in Europe became a battlefield.
Yeah.
And, was unproductive. So for a couple of years after the end of the war, we were shipping 20% of our agricultural produce to Europe. And again, that's corn and wheat and other things. Guess what? Prices went up until those farmlands came back on stream. Same in the Civil War, same at the end of World War II. Our 60s inflation, which was pretty mild, it got up to 6%.
Mm-hmm.
That's about all that happened then. And it came back down to 3 in 1972. And that was because we were trying to defend the gold standard. We had 20,000 metric tons of gold in 1960. By 1970, that had been cut in half to 10,000 metric tons because folks were buying our gold because we were controlling the price of it. They were buying it for $36 or whatever it was and selling it for $100. And they were doing all that they can. We had no choice but to get off the gold standard. But as you so rightly pointed out, Nixon, in trying to defend that undefendable policy, put price controls in. Didn't last very long. It didn't work well at all, as you pointed out. And then he gave up in 71 and then completely gave up in 72, and inflation came down.
Yeah. You mentioned Milton Friedman earlier, and, of course, his famous line was, inflation is always and everywhere a monetary phenomenon, right? And it seems true. And the argument there is you have an increased supply of currency units, dollars in our case, chasing a limited supply of goods and services. So supply and demand. And you just made that argument that that's the reason we've had inflation is because of supply constrictions in the past, right? The arable land, World War I, et cetera. Of course, Jerome Powell kept saying transitory, et cetera. We all heard that a million times. But if the supply and demand is, the most basic law of economics, and that's true, and you agree that it's true, why wouldn't it also be true with supply of currency?
All I can tell you is that we have plenty of situations to study to examine that phenomenon. And I spend a lot of time, I'm writing a biography of America's first banker right now. The first bank in the U.S. started in 1781 to help fund the Revolutionary War, by the way.
Oh, wow.
And, but prior to that point, there was probably never more monetary experimentation than there was in the 13 colonies starting in the late 1680s and pretty much ending with the Constitution in 1787. So you have lots of data to look at this. And my own observation is that it's fairly elastic. The amount of currency supplied can go up or down a long way before you start feeling it in something as concrete as inflation. And if you overissue money, you've got to really, really overissue it. It can't be any of this single digit stuff, which, by the way,
I love
it. Kind of what's happened here.
That was such a good line. It can't be any of this single digit stuff. It's got to be like this kind of stuff. Zimbabwe.
It's got to be like 100%. It's like, we've tracked the currency issuance in the Revolutionary War itself. I have a spreadsheet we just completed in the last few weeks. It's not like you issued $1 million more than you should have. It's like you issued $50 million more than you should have.
Yeah.
The existing supply was 10 million, and all of a sudden it's 60 million. And by the way, at that point in time, they had to refund that currency at 40 to 1. So your dollar was worth what? 2.5 cents.
Right. Yeah. Okay. I guess the other side of the equation that we probably really need to talk about is, if we just decide, okay, debt is okay, we can tolerate the debt for quite a time to come and keep increasing it and keep spending, we have to get people to buy our debt, or countries to buy our debt, especially. Won't they just boycott our auctions and not buy our debt anymore?
Well, you've come to one of the most important facts in all of monetary theory. And the truth is, government debt simultaneously supplies all the money that is required to buy that debt. So let me give you an example here. And by the way, government debt is never issued without the simultaneous event of spending. The government doesn't issue debt and then just park the money for 10
Right.
years.
Yeah. So they spend it into the economy, and that creates a multiplier effect, right? Yeah.
Well, let's even put that multiplier effect aside.
Okay.
Let's be even more basic than that. So you have $100,000 and you buy $100,000 government security. At that point in time, $100,000 disappears from the monetary base of the United States. M2. They pay me $100,000 consulting fee or whatever they pay
Yep.
me. Like
Those
more.
government consulting gigs are great.
That's right. That's right. I'm liking this.
Yeah.
So they pay me, and if you look at the flows in the Treasury General Account, TGA, the Fed, these always happen at essentially the same moment. So they pay me, that increases the monetary base in the United States by $100,000 at the exact same moment that it was depleted. So at the end of every government debt issuance, the money supply is as large as it was at the beginning. And people don't think about that at all. But we can never run out of the money it takes to buy more government debt because it's self-replenishing. And by the way, a relatively small amount of our debt is owned by foreign entities. And that relates to our trade deficit, which I actually am critical of.
Okay.
People
Let's
to
go
do
to that in a
something.
minute. Go,
Okay.
go. You wait on the trade deficit. I just got to ask you, it seems like you believe in modern monetary theory. Are you an MMT guy?
There are many things about it that I think are technically correct view of the way monetary systems work. There's a lot that they don't cover that I spend a lot of time on. There's a few things they believe, like on trade, where I disagree with them. But I think in terms of the technical position on accounting, they're correct. And you don't have to believe them. All you have to do is go get the Fed's data or the OECD's data or the BIS's data and track the entries yourself. These things are things that actually happen and are observable. They're not theories in my mind. They're technical descriptions of what actually happened.
Okay. Okay, trade. You wanted to talk about international trade.
Yeah, there's a couple of problems with trade, I think our trade deficit, which we pretty much had a zero-ish trade deficit for all of U.S. history up until the second half of the 1980s. And then we started to have a trade deficit of 2 or 3%. Now that's reached up to 3 or 4 or 5, sometimes 6%. There's a couple of things about that I think that are deleterious. One of them is when we buy somebody else's goods net, because of course we're going to buy some of their goods and they're going to buy some of our goods. But if the net is we buy more of their stuff than they buy of ours, it increases our private sector debt. That means some individual or some business has incurred debt that is not matched by economic growth in our country. It creates economic growth in the country we're buying from.
Right.
And the debt is incurred at, and it resides in the United States. So, you alluded to this early on, but my fixation is on private sector debt, not government debt. And I think private sector debt can get you in a world of trouble. It brought the great financial crisis. It brought the Great Depression. So, a big buildup in real estate or other kinds of debt is something to be concerned about. So when we have an adverse trade position, it means our debt is increasing without a corresponding GDP benefit. It also means these countries have dollars that they have to do something with.
Right.
Not like they're in the business of being out there and acquiring dollars. They're in the business of selling us more stuff than we sell them, especially China in the 2000s. But once they do that, they got a bucket full of dollars they got to do something with. And the easiest and safest thing for them to do is buy treasuries. And right now, I think the number is of our 32 trillion in debt, maybe like 4 or 5 trillion is owned by foreign governments, and 1.3 or something like that of that is owned by China. We can solve that dependency by getting our trade situation in order.
So you would rather see more production, more exports from America, right? You'd rather see that trade balance be even and not have a trade deficit, right?
I think it's a very powerful and important thing.
Okay. So here's the thing you didn't mention that I just wanted to hit you with. And that is that, yes, you do create more private sector debt when you buy stuff from China, right? For example, and they get the dollars. And so then they mostly just put those into treasuries, which is good for us. That's kind of the circle of the MMT crowd, right? So that's good news for us. But what you didn't mention is that we get the lifestyle benefits of that trade. we get all those cheap goods, right? Now, you could certainly argue that we have too much cheap goods and we just don't need it all, which is a fair point. But we do get the benefit of the equipment. I mean, let's look at like heavy equipment. So, the big transformers that we buy from China, for example, right? Or the rare earth elements that go into our electronics that, well, they're usually making them, but
or the little parasols for our mixed drinks.
Yeah.
You're exactly right. So I am not advocating that we take manufacturing where it's done more effectively than we can. What I am instead advocating is that we invest in the most advanced possible manufacturing, where labor, by the way, is normally a lesser component anyway.
Mm-hmm.
And the more we do of that, the more we will bring that imbalance back to zero. And I'll give you a great example of that. Right now, the researchers here in Philly at the University of Pennsylvania have come up with a way of altering the genetic structure of T cells to cure diseases like certain types of cancer.
Yeah.
Called CAR T therapy, and it's a big breakthrough. And they also did the mRNA work. Well, CAR T requires manufacturing. And once you've figured it out and you have a lot of patients, you've got to build a manufacturing facility to do that. By the way, that manufacturing zero operates at almost absolute zero.
Mm-hmm.
It's operated by MD PhDs. These aren't $15 an hour people.
Right.
And it's a process whereby there's actual assembly lines where we take Jason Hartman's T cells and we alter them and we grow 1 billion of them and we repackage them and we send them out to cure his disease.
Yeah.
Let's do a lot more of that kind of manufacturing.
Right.
Those are great jobs. And a lot of that, by the way, is a function of government supplementing investment in really advanced, hardcore research. This is the NSF, this is the NIH, where our spending, by the way, is almost, it's like a rounding error to the total federal budget, but where the payback is huge.
Yeah, no, that's a good point. I mean, China is not good at that. They don't produce high-end chips. Maybe that's why they want to take Taiwan over, but that's a whole nother discussion. So, okay, good. Well, Richard, this is a fascinating viewpoint and a fascinating discussion. Anything else you want to say, question I didn't ask maybe, or just things you want the listeners to know?
Well, no, just that I'm really grateful to you for having me on, and appreciate the discussion. And I think if folks want kind of a holistic view of the economies of the biggest 7 countries in the world, that's what Paradox of Debt is about. And especially if you're a data person, I think you'd enjoy the book.
Yeah, and just before you go real quickly, tell us about your other books.
One of them is A Brief History of Doom, which is really a chronicling of the largest financial disasters in world history in the big 6 countries in the world. That would include the Great Depression, that includes Japan's crisis of the 90s. Another one that I think folks would enjoy is called An Illustrated Business History of the United States, which really covers U.S. business history, really from 1748, when young George Washington and his brothers tried to buy 500,000 acres in the Ohio Valley, all the way up to, the present world of Google and all the rest. And it really divides it into, what we consider the 16 business eras within the United States. It's illustrated, so it's a lot of fun. It's not as boring as you might think.
Right.
And we've done a couple of others, one on Jubilee, one on predicting financial crisis. So,
yeah. Speaking of Jubilee, do you think there will be a debt Jubilee?
Well, one of the points we make in Paradox and in Jubilee is that debt as a function of GDP has been growing perpetually forever. And it really never goes down, and it does go down and that precipitates a calamity. But, it's this ratio we talked about earlier. Debt in 1980 was 125% of GDP, it's 260. What we illustrate is that that's not a bug of the system. That's the way the system is built.
It's a feature, not a bug, as they say.
It's a feature, not a bug. Well, if debt is perpetually rising, something's got to give at some point in time. And so we get speculative and talk about potential ways to do that are fair and productive. And then we take you into the past and talk about how Jubilee was a feature of ancient civilizations, because debt has been an issue in civilization since civilizations first arrived.
Mm-hmm. Right, but the debt jubilee, I mean, the lenders wouldn't like that.
Well, it ain't easy. If it was easy, anybody could do it.
Right.
And
Yeah.
so we try to come up with, back in ancient civilizations, kings could do it because it was their debt.
Yeah.
And one of the cool things about ancient civilizations is if you as a king didn't do it, there'd be some invading king that would come to your town and send messengers in and say, if you'll be on our side against your king, we'll forgive all your debt.
Yeah.
So, there are little things like that. So, something's got to give, and we explore ways to do that.
Yeah, very interesting. Richard Vague, fascinating discussion. Check out his books in all the usual places. Richard, did you have a website you want to give out too?
Paradoxofdebt.com.
Excellent. Richard Vague, thanks for joining us.
I sure appreciate it.